I'm going to teach you everything you need to know when it comes to getting an FHA loan. This is a fantastic option for people who have a low credit score and also want to have a low down payment. If you stay long enough in this video, I'll even tell you a strategy on how to save a lot of money in your pocket. FHA stands for Federal Housing Administration. Basically, this is a loan insured by the government, where if a bank lends you money on the basis of FHA and it so happens you can no longer make the loan payment back, the government will come along and pay for the unpaid principal balance. The Federal Housing Administration tells the banks this: here are my standards when it comes to giving out these home loans, and if these standards are met, I will ensure the money that you lend on the case that you are not paid back. FHA now can help you get a loan even if your credit score is below 620, as opposed to the other loan programs. In some cases, you can even get a loan down to 500 credit score. This brings us over to our first requirement, credit score. If you have no clue what credit score is, it is a score that tells the lender on how well you can pay back your debts. Your ability to take out a loan completely depends on how your credit score is, and if you do not have a score or want to learn how to fix your score, subscribe. I will be posting videos on how to do exactly that. For now, all you need to know is that there are 3 credit reporting agencies and you will need a Tri-Merge credit report. Here you will see scores from TransUnion, Equifax, and Experian, and the middle of the 3 scores will be used for your FHA loan application. The second thing you need to know is the purpose of the property. FHA requires you to live in the home that you want to buy for at least 1 year. Therefore, this loan is for your primary residence. And since the Federal Housing Administration expects you to live in the house, there's going to be higher home quality standards that must be met for the bank to lend you money to buy the house. Although you need to live in this home, you still have huge investing opportunities because FHA loans can lend you money on that property that can go up to 4 units. And as long as you live in 1 unit, you can rent out the others. Coming from a real estate investor myself, this is absolutely ridiculous. Why? That's because banks are lending you money where you can basically live rent-free if you're able to play your cards right. Third, we need to cover the down payment. And depending on your credit score, the minimum down payment is either 3.5% down or 10% down of the purchasing price. If your credit score is 580 or higher, the minimum down you need to put down is 3.5%. If your credit score is below 580, then your minimum down is 10%. This is a pro for FHA loans because there's no other loan program that will allow you to pay so little down when your credit score is below 620. Let's say you want to buy a house for $100,000 and it is a single family residence and you have a credit score of 590. The minimum down that you must put is 3.5 thousand. So if you go ahead and double that, that's going to be 7,000. Now, if you were to buy a house with 3.5% down, where does the other 96.5% of the money come from? Well, that actually comes in the form of a loan. Now, to determine how much you can get for a loan is going to be coming up next, which is debt to income ratio. But before we talk about debt to income ratios, please do me a favor and smash that like button. Debt to income ratio is a fancy term that basically means on how much debt you have in compared to your income. And when I say debts, we are talking about debts that will show up on your credit reports. Therefore, this does not include phone bills or even utility bills. To figure out your debt to income ratio, it is actually very easy. Let me give you an example. Let's say I make $30 an hour, work full-time, where full-time is 40 hours a week. Let's go ahead and multiply that by 52 weeks and divide by 12 months. Then my monthly income comes out to be around $5,200. Now, let's say on my credit report, I have 1 car payment and also 1 credit card payment, $500 and $25 respectively. If we add up all my debts and we divide that by my monthly income, that means my debt to income ratio is going to be around 10%. On the case for banks, there's going to be 2 debt to income ratios that they are looking at, the front end and then the back end ratio. The front end ratio is basically the maximum house payment that the bank is willing to let you have, whereas in the back end ratio is the maximum ratio that the bank is willing to let you have for all of your debts put together. We just now calculated that, and depending on your credit score, you will have different ratios that you must not go over in terms of the payments. Going back to our example with 10% TTI, let's say our credit score is 590. We'll be using this ratio, 31 front end, 43 back end. I will calculate the front end by multiplying 31% to my monthly income, which gives us $1,612. Then to get our back end, we're going to get 43% and minus that by 10%. That's going to leave us with 33%, and we multiply that number with our monthly income, and that comes out to being around $1,711. Now, the bank is going to qualify you based on the lowest payment between the 2 ratios. This means for our example, the maximum monthly mortgage payment that we can have is $1,612. But keep in mind that my mortgage payment needs to include the loan payment, the property taxes, and also the insurance. So if we were to buy a house for $100,000 and we have a 3.5% down payment, payment, we now need to pay $96,500 in terms of the financing, or also called the loan. Then on top of that, we need to make sure that our loan payment is no larger than $1,612. So let's say we take out a loan with an interest rate of 7%. Our principal and interest payment is going to be $642, which leaves us $970 a month to cover the insurance and also property taxes, which in this scenario is actually pretty doable. And for this property, I will go ahead and estimate the taxes and insurance to be around, let's say, $400. But what happens when you want to buy a house that is $250,000? Just in terms of the principal and interest payments, if we use the same 3.5% down, our principal and interest payment is going to be $1,605, which is very, very close to our $1,612 maximum mortgage payment. So what we need to now include is our taxes and our insurance are definitely going to be a lot higher than the $1,612 maximum payments. So now what we need to do is we now need to consider compensating factors. Compensating factors are basically personal financial traits that allow you to increase the amount you could borrow. One example of compensating factor is having a large amount of savings. Usually lenders are going to take a look at how much you have in terms of your savings and divide that savings amount by your monthly loan payment. For example, let's say I have a monthly loan payment of $2,000 and I also have a savings of $20,000. That means that we would have around 10 months of reserves. And if there are lots of strong compensating factors, then we can go ahead and increase our front end ratio to 46% and our back end ratio to 57%. This then leaves us with a new maximum loan payment of $2,392. But that is assuming that we literally hit an entire list of compensating factors. But either way, that is still a 48% increase in terms of how much we could borrow. But as a huge disclosure, I highly advise against maxing out your monthly house payment. Just because you could borrow that much money doesn't mean you should. Okay, so far I told you what is an FHA loan, credit score, property purpose, down payments, debt to income ratio, and even reserves. Now we need to talk about mortgage insurance. Remember, we are borrowing 6 figures worth of cash. Therefore, there's a lot of risk on terms of the bank side, even if the government's going ahead and insuring the bank. And as with all good things, there's going to be a cost, and this cost is called mortgage insurance. Now, FHA loans have 2 parts to their mortgage insurance. There's an upfront fee of 1.75% of the loan amount that you are borrowing, and there's an annual fee ranging between 0.15% and 0.75%. When you decide to take out an FHA loan, you either have the option of paying the upfront fee out of pocket, or you can just add that onto your total loan balance. But keep in mind, if you do not pay the fee out of pocket, you are now borrowing more money, which increases your monthly payments, and on top of that, you are also paying interest on the additional money that you borrowed. On the case for the annual fee, things are a little bit more complicated. Your annual fee depends on how much you borrowed, how long you've been borrowing, and how much equity that you have on your home. There is a way for you to remove this fee, however, it is a bit difficult. You would need to make on-time payments for 11 years straight, and when you first bought the house, you would have needed to make a 10% down payment. Since we've talked a lot about what makes an FHA loan, now we need to talk about what is the bank going to ask from us. Well, all we need to do is prove income, assets, credit score, and also living history. We need to show the bank that we have 2 years of consistent income, employment, and also previous residence. And to do this, we need to share the past 2 years of our taxes, past 2 pay stubs, and past 2 years of our residence. Then for the final cherry on top, we'll need to provide the 2 most recent bank statements to show how much savings we have in the bank. Now that we have an amazing foundation for the knowledge of FHA loans, I'm going to give you a little strategy on how you can save a lot of money in your pockets. Since we are in 2024, I will give you a small market update. Home prices have been staying the same value for around the past 2 years, and on top of that, interest rates are at a 20-year high. With these circumstances, smart buyers are starting to take advantage of the current market conditions. What you can now do is ask for seller concessions to help you in terms of the closing costs. For FHA, you can ask up to 6% of seller concessions. And seller concessions is basically money that you ask to the seller of the house to credit you. It might make your offer a little bit less attractive, but hey, for the right house, it's worth a shot. All you need to do is find a house that has been on the market for a prolonged period of time, and you need to make sure your real estate agent is a good negotiator. However, if you really, and I mean really like the house, and that you see there's a lot of competition on the house, I would actually suggest offering more than the initial sales price of the house so that the seller doesn't truly lose money. The only caveat here is the fact that the home would need to appraise higher in terms of the value. That is all for today's video. I know this is a lot of information, and if you are feeling overwhelmed, don't worry, you'd be very surprised on how common it is. That is why I'm here. Feel free to reach out to me via info in the description and comments, where I can personally help you get pre-qualified for an FHA loan. And if you want to learn more about real estate, mortgages, and also investing, hit like and subscribe, and And other than that, have a great day.